can't be a Marine by reading a book. You can't really be a turtle trader, as good a turtle trader as you would unless you work for Richard Dennis and Bill Eckhart. Systematic, trend following, has a tendency to make money when we see things that have never happened before. I heard Paul Jones speak in 1988 at UVA, and he talked about being short Japan and making a lot of money in that stocks trade. And his response was, what people don't want to hear is that I was short 5 times before that and took small losses each time. We don't vol target. We're kind of traditional classic trend followers where we risk a small amount, but if the volatility gets higher and higher as the trade becomes very, very profitable, we don't have a tendency to get out of any of it. We just sort of let it go. And so you got to be a little different.
Richard Dennis is one of the world's most famous traders from the Chicago pits of the 1980s. He knew his proven trading strategy could be taught to others. He gathered a group of 11 traders in Chicago to teach them this system. These people became known as the Turtles. Jerry Parker is arguably one of the most successful of these turtles. Taking his newly learned trading strategy, he founded his own CTA, Chesapeake Capital. I had the pleasure of sitting down with Jerry recently to discuss his background as a turtle and his trend-following trading strategy. Please enjoy this episode of Skin in the Game. So here we are on Skin in the Game with Jerry Parker, CEO and founder of Chesapeake Capital and one of Richard Dennis's original turtles. Want to play a game?
Yes, I do.
All right.
Let's do it.
What color you want to be?
Gold, of course.
Gold. All right. You want to go first?
No, you go first.
All right, I got it. The middle one. Let's see. I'm going to pretend that this is Virginia in last year's playoffs where they went out in the first round.
Oh my, nice. Thanks for those memories. My Lightning are going to do the same thing.
So Jerry, let's start at the beginning. Take us back to 1983. Tell us your background. What were you doing then before you saw the ad from Richard Dennis to become a turtle?
Living in Richmond, Virginia, working in public accounting, destined for lots of boredom and no fun. So it was pretty easy for me to figure out that I wanted to do something different in the markets and trading and stocks or bonds or currencies or commodities. I had a very open mind about where and what I wanted to do.
So you had an open mind and you saw this ad in the newspaper?
Yeah, I was looking at the ads in the Wall Street Journal, the summer, fall of '83, and Richard Dennis wanted to hire people and teach them how to trade futures, give them a stake, money, and pay them a percentage of the profits. Probably the most important thing is I had heard of Richard Dennis, so I knew it was totally legit. And I thought futures, well, that could be okay, currencies, commodities, stocks, bonds, long and short, that sounds good. More diversification. But of course, I was mostly learning and reading and wondering about the stock market, but totally open to leverage and shorts and diversification.
So Jerry, tell me this. Where did the name Turtles come from?
Good question. We're 12 people in the room trading, and there's a big apparatus around us with the clearing and the C&D commodity people and the brokers, and they want to start nicknaming this group. And of course, we want a nickname. So it was, the 12 apostles. No, that's no good. But evidently, Rich was traveling in Singapore, and they come across a turtle farm or place where they're raising turtles. And someone said, "Hey, Rich, that's just like you raising traders in Chicago." So that's the truth. And there's so many different explanations of turtles. Was there a bet? I'd say there was no bet if trading could be taught. Rich did not bet Bill, but you can take my word for it. That's how the turtles came about.
Okay, now we know.
Now we
know the origin of where it came from.
Great nickname. I do get embarrassed in the middle of meeting brand new people, and my wife goes, "He's a turtle." I'm like, oh my God. Oh, gracious. Oh gosh, I need to think in other terms here. I like that. I like that.
So how did it go? How did you get to become one of his turtles?
Well, like I said, the most important thing was seeing the ad. I had been reading a lot of books and sort of was interested in Marty Zweig, who's a sort of a famous guy who was, some trend-based and sentiment-based, which ended up being very similar to Richard Dennis. So I was pretty knowledgeable on paper about how to trade and what worked. I mean, I thought trend following was wonderful. The more I heard about it, the more I liked it. And so I just, took a guess. Well, hopefully, if I get an interview, Richard Dennis would be a trend follower as well. So I didn't really know for sure, but that ended up being very fortuitous.
I sure did. So you went out to Chicago and you learned from Richard Dennis while you were there.
Yeah, well, I went for an interview, and so maybe 1,000 people applied for this job in, the end of '83. They did it again in '84, and so I went to Chicago, and for the interview, I think they maybe interviewed 40 people. They had sent out a test. When you sent your resume in, you got a test, 100 true-false questions about trading and psychology and how to think about the world and markets, and so I took this test, sent it back in, and when I went up there, they said, well, how do you think you did on this test? I said, I think I did pretty well. And they said, yeah, you had the highest score out of 1,000 people. That story has been misstated many times, that somehow I had a perfect score. Not true. Just the highest out of 1,000. But they wanted to hire people who had done well on the test and people who did poorly but had other things going for them, like backgammon players, actors, a lot of normal people, but that was my claim to fame, doing well in that test. Thankfully, I was sort of prepared. And then they asked me another question they asked, I think most people, was, how much do you think you already know about the markets? And so my answer was like 95%, which is kind of laughable, of course. It didn't take me long to realize that was wrong. I think one other person said 99%. And then,
oh, really?
Yeah, and then Liz Cheval, the only woman they hired, of course, she said like 0%. So kind of a good lesson there. And but yeah, they took pity on us, and they hired me anyways. And then we had like a 2 or 3 week course, and then January the 2nd or so, 1984, we started trading.
That was a nice one, but I have little kids, so I know that move.
Gosh, I feel like I should close my eyes.
So you started trading after the course there, and then how long were you there trading for him?
That program lasted 4 years, and I lived in Chicago for 2.5 years.
So the program was preset already? That would be a 4-year program?
I think it was originally a 5-year program, but I think at the end they kind of got tired of it or decided, the experiment had ended, which was,
right.
Can you teach trading? I think that was one of the ideas they had, that they would like to know if you just get sort of random people, or maybe people who are a little bit smarter than random, can you teach them trading? And since it was rules-based, it was basically that, can you teach these rules? And of course you can. So I think the most important thing that was decided was when you teach 20 people the rules, how many of them are going to continue to follow it, or even follow it from the beginning? There was all sorts of reactions to losing money, and did Rich tell us all of the rules? Are they withholding rules? We're having drawdowns, we're losing money. They must have other rules they haven't told us about. A lot of silly stuff, but it was really fun, being there with in a room. All the turtles were in one room. A lot of ping pong playing, and a lot of fun times.
Did you talk about your trades with each other?
Well, I think another thing that happened was I think they wanted people to be different and maybe take the rules and expand upon them a little bit, add some flair. That was a word they threw around a lot, flair. Add your own kind of style, not too far. Don't drift too far away from what we were taught. But I think with everyone being in the same room, people perceived more risk in being different.
Right.
So almost when a certain soybeans became a trade, 20 people picked the phone up at one time. That's not too far off. Although when we get together, we tell stories about some of the things that happened, and some people were like, that never happened. So maybe my memory's not that good.
So tell us more about when you left Richard Dennis's program, what did you do next?
Oh, we have to raise money. We had no experience doing that. We had the greatest client of all time who loved everything we did because it was his, and we were just there to carry it out, and we loved doing that. But we were back into the real world. We had a great track record. We had so we could show people 200% years frequently. People are greedy. They want to give you money, do this for me. Once I was walking around Wall Street, and this is before I had cell phones, and I'm going up to the payphone, and I call the head of Merrill Lynch Managed Futures, and I say, Jerry Parker, can I come up and talk to your boss about Chesapeake? And she goes, no, you cannot. And I said, okay, well, just tell him that I am a turtle, Richard Dennis turtle. She says, hold on. She comes back, she's laughing. Yes, please come up. So life was easy and good because of Rich and because of the track record. And the whole turtle story helped us a lot for a long time.
I carried you along.
It carried us, yeah, exactly.
That's great.
Yeah.
All right, so you were there for 4 years, and then you left and you went and started your own CTA.
That's right. We had an incredible asset when we left. We had a good track record. We had a track record, which is very important.
Sure.
We had a good track record, but trading was much different back then. It was trend, diversification, but it was shorter term, massive amounts of leverage. I would say that most of the time, the performance in the room was around 200% plus. Wow. For everybody. Everybody was in that range. Once again, everybody had the same rules, the same opportunities, and so there was really no reason for me not to do well. I was just, momentarily not doing what I should do. And so, yeah, we had a good track record, lots of experience, and it was a pretend environment. It was, I've often said it's kind of like, it's a bad analogy, but sort of like, you can't be a Marine by reading a book. And so you can't really be a turtle trader, as good a turtle trader as you would unless you work for Richard Dennis and Bill Eckhart, because, it's just like do the right thing, do the right trade, but I'm losing money. Doesn't matter. If you do the right trades and you lose money, you'll be fine. But if you don't follow the rules and you don't do the right trades, but even if you're making money, you may be in trouble. So it was just a constant encouragement to don't worry about it. You're doing the right things. You're doing the right trades. The type of feedback that you never get from real clients. It's like, I don't care how you do it, just make me money, So Rich designed the systems, he designed the program. We had tremendous training from literally two genius people. These were geniuses. Every opportunity to do well and being encouraged. If we lost money, sometimes they would give us more money to manage. But I think that's the untold story is how smart these guys were and how they prepared us for a career, not just here's how you trade today, follow these specific rules. No, you've got to evolve, you've got to change, you've got to stay alive. And there are some 10 commandments of trading or trend trading, but then everything else needs to stay up with the times.
It was rules-based, and you took it back to Virginia, opened your CTA, and was it always market trending, or did it just kind of turn into be market trending because of the way you used it?
Well, I think it was initially trend, and but I don't think that was what they meant it to be. I think many years later, I came to the conclusion that as much as I don't have any interest in doing anything except trend and momentum, their ideas were, no, this is, trend works now, this time frame works now, but it's really about doing the proper research and back testing and evolving. And so if that's shorter term or counter trend, so be it. Mm-hmm. But I sort of took it to, trend was the only thing I was really interested in.
So at the time, it was short term. However, since then, you've kind of evolved into more longer term trends?
That's right. I think that's one of the major changes and needed evolutions was to realize probably in the late 90s, the shorter trend timeframes were not profitable. And I've just often said that it was, a lot of computers, a lot of trend following, a lot of back testing. A shorter term is desirable. The drawdowns are smaller, let's say, if it's profitable system. But it just in order to maintain profitability, the look-back periods had to be extended quite a bit because of the choppiness and the looking for people's stops or all the shenanigans that goes on. And, so we've definitely become more of a, 6 month to a year holding period.
How did you manage, or how do you manage to stay away from some of these big spikes where people get stopped out of the market and some people even go under because of it?
Well, I think the two most important things I was told, and I firmly still believe that, are follow your system and then trade small. And I think that is the root of a lot of trader problems. I can't follow my system, probably trading too large. Big swings, I'm losing clients, probably trading too large. Can't sleep at night. And so that should not be discounted about how those two kind of go hand in hand. You must follow the system, but also risk an amount that is normal and reasonable for you and for your clients.
So does that come where your position sizing comes into play?
Position sizing comes into play for sure. That was part of the Turtle program. It was the entries and exits are important, building a portfolio, sizing the trades properly. A lot of details. It's like building a home. So many details go into crafting a trading program.
So when you're building your portfolio, how do you diversify among the different instruments that you trade?
Diversification is very important and powerful. And so we do analysis of the markets, back testing and other ways to try to get a handle on which markets we should have in a portfolio and how they're all correlated, and understanding that these things change. Oh gosh, they change. So once you get it all squared away and you get all the decimal to the fourth decimal place, it changes. If you run, most of the time, if you run an analysis on heating oil and crude and gasoline, they're 90% correlated.
Right.
But the first big turtle trade of all time was Feb heating oil. It doubled. And January heating oil didn't go up very much. March heating oil didn't go up very much. There was a freeze in New York Harbor. They couldn't get the heating oil in.
Wow.
That 1 month. So trend following makes money. Systematic trend following has a tendency to make money when we see things that have never happened before. So you want to build your portfolio safely and realize, crude, heating oil, and unleaded is pretty much the same trade. Oops, not all the time.
Right.
1990, December, I made 30% in December. I made 30% for the year, and I made 30% in that heating oil trade. So this is a dilemma. What are you going to do? You can't ignore it, but then you have to be prepared for, in 1987, silver doubled, correlated with gold, 90%, let's say, but gold kind of sat there. So these things happen. The markets are weird. I think as much as we look back on history to see, where's a pretty good place to buy, where's a pretty good place to sell, I don't think history is a great guide in the sense that what's going to happen in the future will be much different. These techniques and tools and parameters, they may continue to work in a similar way, but they're capturing different trends. And when crude goes up a lot or when crude goes down a lot, it's usually going to, and whenever these markets have big moves, it's usually a surprise. No one really sees it coming.
Right.
Yeah.
It's interesting because, you talk about this, and from a trader's perspective, you look at things and I'm always like, am I in a trade right now? Is this the beginning of a trend right now? And then you get in it and you're in the trend and you're like, when's it going to end? And you're like, is this the top? Is this the top of the trend? How do you figure out if it's the beginning of a trend or the end of a trend?
In hindsight, that's how you figure it out.
Yeah, of course. Right, exactly.
I heard Paul Jones speak in 1988 at UVA. We all got in the car, drove from Richmond to Charlottesville to hear him give a talk at the business school. And he talked about being short Japan and making a lot of money in that short Japan stocks trade. And his response was, what people don't want to hear is that I was short 5 times before that and took small losses each time. And the same with our crude trade in 14, where the CTAs got short at 90 and it went down to 20 somethings. We had been chopped up in that crude market, for months and months. And then when we sold it the last time, we were as surprised as anyone that it had such a big move. So I think that's another thing about systematic or trend, or the way that I look at the markets, is that how can you make money if you're going to be surprised? How are you making money if you're losing on most of your trades? You get bailed out by these mega winners. So that's the key, I think, for a lot of traders is small losses, be bold with your profits, hang on, and get yourself in a situation where you can be tough and strong and not get out too quickly. I think more money is lost anticipating a trend reversal. Even as painful as a trend give back will be, it's mostly just embarrassing though, or it's just kind of like emotional. It's not usually a fatal amount of money because you've made so much in the trend to begin with.
Well, you have to have some discipline to be able to stay in, like you were just describing.
Yeah. No, it's the major requirement. Maybe that's what we really add to portfolios and to the whole process is just that we're dumb enough to keep doing all these trades. We don't care. We don't care if it's been 5 losers in a row in the same market. I mean, we kind of care, but we're sort of committed to doing it. The back test, when you do the back test or you look at historical performance, oh man, I would have done that trade every single time.
Right. Yeah.
Not a problem. I mean, no, you just do it, and then when you get on the firing line, it's a different situation.
Sure.
Yeah.
The advantage of going first seems like when you go second, you're always playing catch up. So I saw you speak last year, I believe it was, and you said that you divide your portfolio up to be diversified, basically 25% fixed income, 25% commodities, 25% equities, and 25% currencies. Is that mainly how you do it to stay so extremely diversified so that you won't take a big hit?
That's a good approximation. I think that's how you want to look at it, putting together diverse asset classes, like maybe a little bit more commitment to the commodities or the single stocks, because there's a little bit more diversification there than the currencies or the
Right.
interest rates. But that's pretty much what you want to do. We have a big edge by having all those markets in the portfolio, a really big edge by having shorts on. Most of these markets are positively correlated. So things are up a lot or the whole portfolio is down a lot. So having longs and shorts is very important. One of the things that I do is I don't go back and look at prior performance, historical performance. So the yen may be the best performer, crude may be a great performer, but I would never overweight those. It's just purely based upon the contribution each market gives me to the diversification. That's, I think, how you want to set it up. You're doing back tests, you're looking at the past, but the future is going to be different.
So that was kind of leads to my next question. You said you don't really look at the historical data, but you do back testing.
We do back testing to get an indication of what time frame of trend following should we try to adopt. Long-term, short-term, medium-term, what does that even mean? What's the look-back period? What has worked? The markets are choppier now. There are a lot of whipsawing, so it's probably better just to be longer term. But when it comes to putting together the portfolio, we are just looking at the markets in terms of the diversification properties that they offer,
Okay.
which can change and fluctuate over time. So it's not going to be perfect. You can't predict the future, but if you buy this breakout and then sell that breakout, that's probably your best indication of making money, even though we're not really predicting. We're wrong 60% of the time. So don't follow us. If you did the opposite of what we do, you'd probably be right more often.
How about the markets right now? Is there anything you see that stands out in terms of each of those asset classes that we just talked about? Maybe commodities, anything you're looking at right now?
I think it's always kind of problematic for traders and trend traders to talk a lot about their short trades. Historically, the shorts have not been as good as the longs. So I'm really focused on, where are some commodity longs? Where are my longs? So there's maybe the base metals are strongish. We rode the palladium. That's had a big sell-off though. We kind of rode that. The cattle and the hogs are kind of strong. It's nice. Weird, I know, but lots of diversification in those two markets. But most of the commodities are still short, the grains,
Right.
The precious metals. Made a run for it, but getting hit here recently. Currencies, mostly short versus the dollar. Starting to see a little bit of that changing, which is nice. And the stock portfolio is longs and shorts. That's good. I think that's one of the edges that we think we have, is not trading indexes, but trading single stocks, where I can go in and once again create a stock portfolio that I create, not what the S&P 500 gives me. And I can take a couple of stocks from each sector, sub-industry or whatever, and put myself in a highly likely situation where I will have some longs and shorts. It's kind of odd, like, why don't you just try to find just the long? Stocks are going up. Yeah, I agree. I should try to find that, but my primary goal is to seek diversification. All these trades in the trend following world, they're going to make about the same amount of money over time. We certainly don't believe that stocks are superior. They should be in the portfolio because they offer diversification. In 2014, the CTAs did really well, and mainly because of stocks. Sometimes it's the only thing going. But certainly the last 10 years are much different than the 10 years before, where it does seem that diversification has been penalized to some degree. But I'm sure that's going to change, hopefully. Oh no. Congratulations.
Am I allowed to win? I don't know.
Yes, you
are. You're one of the few CTAs that will trade single stocks. Is that correct?
Mm-hmm. We are. I think just from the very beginning and from the Turtle program, it was just a tremendous emphasis on diversification. Trading single names just seemed an obvious thing to do.
Right.
It's a pain in the butt. It's much easier just to trade the indices, and all of your markets are in this FCM account. It's just a piece of cake. Clients kind of prefer it, and but you need to stand up and try to do something better and different, even though clients are not asking for it. And maybe they complain about it a little bit. I've definitely had people complain that, well, I understand the trend following of the currencies and the commodities and the bonds. It's getting a little too close to me for you to say, oh, just follow these trends in the stocks, and I don't really think that's right. And so we're like, well, sorry, we're going to do it.
Yeah.
And we've had a lot of success with it.
I'd imagine that diversification held you out from some of those, or maybe you didn't lose as much during some of these big equity sell-offs that like we had in the fourth quarter of last year.
You don't lose as much. You don't make as much. When the markets are in a big uptrend, it's hard to beat the S&P or the FANG stocks.
Mm-hmm.
You don't make it on the upside. But it definitely reduces the drawdowns. And in the same way that I would not desire to trade the dollar index or the euro only or a commodity index.
Sure.
I like having longs and shorts. I complain when I don't have longs and shorts in the currencies. So yeah, it makes perfect sense in the stocks as well.
So people are your clients because they like the stability that you offer.
Yeah.
Besides you're making them money.
Yeah, exactly. It's different. And we do things differently than we don't vol target. We're kind of traditional classic trend followers where we risk a small amount, but if the volatility gets higher and higher as the trade becomes very, very profitable, we don't have a tendency to get out of any of it. We just sort of let it go. And so we're a good complement to all of the European CTAs who are vol targeting. And
right.
So you got to be a little different.
Right. What would you say is the largest drawdown that you've ever had?
Well, definitely Richard Dennis. I lost 60% in one day. 1986, we're just making so much money, and I know we were up 200%. And I went home on Friday at peak equity, and I think my bonus was $1 million, and I was just on top of the world. And Monday was just this day of all the markets going against us. We had made so much money so quickly, and just like, oh well, such is life. If Rich approves of it, he's telling us to do. We think we're doing the right thing, then it must be right. And but I quickly figured out 1988 when I started Chesapeake that maybe 200% was not what I should go for in order to have a stable business. But I do remember being jealous and hearing my other turtle friends who had not made that transition quite yet doing really well in that the drought in 1988. So, but yeah, it's an evolution over time. A lot of positives from the turtle program and a lot of things that you have to get out of your head when you trade sort of client money.
Is it a lot easier now with computers as compared to like the 1980s where you had to execute everything by hand and pick the phone up and make a phone call down to the pits? Now you have these algorithms and you don't necessarily have to make the decisions right there because they will do it for you. In a sense, you program them, but in a sense, you don't have to actually go in and physically do it. Does that take a little bit of pressure off of you?
I think it makes us more disciplined, and you probably the traditional CTA firm would have a research department that creates the models, a committee that approves the models, and then you run those models each day on the new data, and then you have a separate department that executes the trades. So the guys who are executing, their only job is to get a good fill.
Right.
And everyone else's hands are tied. They can't walk in there and say, hey, do a Jerry trade or do a Joe trade. I'm getting freaked out. So I think this division of duties gives people more consistency and discipline. There's still ways to what I call systematized discretion. It's really easy sitting in front of the computer and saying, I'm really nervous about this coffee trade. I think coffee skyrocketed in 1988 as well, or 89. And I remember sitting there going, I really want to get out of this coffee. It's just going up too much. So now I think more than a lot of people just program that in. But it's a rule. Right. So rules are not a panacea either if you have a bad rule. And I think there's a lot of temptation is to have bad rules. I've done it before and just think that you can get away with it because it's computer code. You can't.
How about on the other side? What was your biggest winner?
We've definitely had some trades that lasted a year or two or three. Yeah. Short yen, I think in the 90s or 2000s. Crew trade in 14 came at a really good time, 90 down to 20 something. There hasn't been a lot of great trades. The heating oil trade I mentioned earlier, both of those are legendary trades. Natural gas, there's been some major moves in natural gas, 87 or 88 drought. The base metals in 04, 05, 06, gigantic trades that lasted a year or two. When you put up a weekly chart, I'm not saying you need to trade weekly, I'm just saying put up a weekly chart and scroll through the charts. Massive trends just pop out. And you look at the little jig, in the middle where it goes down a little bit and comes right back, like, it's a piece of cake. You blow it up into a daily. Yeah. It's like, oh my God. Or you live through it, Living through things. I think Bill Eckhart has a good quote. I can't remember what it was, but something like, today is really a bad day and it's really important, but you won't even remember it, in a month or two.
Right. I can see that.
Yeah.
Got me. Well, thanks for coming in, Jerry. It's been fun.
Joe, so much fun. Thanks for having me.
I'm glad we got to talk about your background a little bit, your investment strategy, and where we are in the markets today.